In this video, you'll be learning about this topic. So Ed, we see China and the US continue to decouple. This is the classic example of rival powers. Just to mention a few examples, the US has made it more complicated for the Chinese companies to be listed in the US, and China has invested heavily in eventually being self-sufficient with energy and semiconductors. How can I, as an investor, take advantage of this increasing decoupling?
It's a good question. I think that the way that I would answer the question is that it seems to me the obvious outgrowth of the decoupling over time is that China is going to form its own ecosystem of countries that are around it so that those are reliable trade patterns. Where the United States used to be a trade pattern, people talked about Chimerica. That's no longer, so that they maybe have a more regionally based trade relationship with other countries. And those countries, they can trade in their own currencies. The upshot of that is that the US dollar becomes less important for those countries. And probably that's in Asia in particular. So to the degree that the US dollar is less important from a capital account perspective, that would suggest that the United States capital account surplus that people, because they want to get dollars, will become less than it was before, which means the current account deficit will become less as well. Interestingly, I would imagine that that means a weaker US dollar over time and a stronger yuan, stronger Asian currencies that are tied to the yuan in that trade relationship. And therefore, to the degree that you still have strong growth in those markets, you also therefore have stronger equity valuations, whether you're valuing them domestically or in foreign currency. You get the foreign currency appreciation if you're not doing it domestically. One thing to think about too, I think, in terms of these currencies is that they also a lot of times have had US dollar liabilities. If they're creating trade in bilateral relationships and they don't need the US dollars, maybe they don't need US dollar liabilities as well. So that's also a locus of problems that they no longer have. If you think about the 1998 Asian financial crisis, maybe that crisis doesn't happen because that was actually as much a dollar problem as it was a debt problem, a liquidity crisis as much as a solvency crisis. So to me, that says that emerging Asia, ex-China, could be attractive in that relationship. So that's how I would play that as a long-term play.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.